Welcome back, everybody. Great to be here. Ed Ponsi, your FX educator. Second session of the new year. Let's kick it off. Let's get it going here, everybody. How do you feel? Okay, I hope you feel good. I hope you're ready. I hope you're feeling all right. I hope you're ready to make it a good year. Let's make it a good year, and let's take over. Let's take control here. So we were talking about Aussie. We were talking about New Zealand. If you missed the first session, please check it out on the replay. You read all these articles about, what's the coming year to expect. I don't know what to expect in the coming year, to be honest with you, but we've pretty much laid out where we stand right now. It sure looks like we're in the middle of a global economic recovery. And it sure looks like, I don't know if China's actually showing it in their economic numbers yet, but if you see it in Aussie and if you see it in copper, you'll probably see it in China's economic numbers sooner or later. Okay. Speaking of economic numbers, we took a look at a group of numbers earlier from the U.S. and from Great Britain and from Europe, and what we did not get to is that we still have to come some manufacturing PMIs out of Canada, which is coming up at the bottom of the hour, and we have also the U.S. coming up at quarter of. So those are the next ones. Let's take a peek at Canada. We never got a chance to look at that one on the previous session. So let's get over to the Canadian dollar, which is on a roll, much like many of the other commodity currencies. We saw a hammer form on the last trading day of the year and promptly stomped on that hammer today as the relentless move continues in USDCAD. And, it's driven by dollar weakness. I mean, we're seeing that all of these currencies are running roughshod over the dollar. But that's not necessarily a bad sign. Look, when the U.S., I'm going to show you something here. We touched on this earlier, but long term, I'll show you weekly here. This was not a terrible time for the economy. We had the economy was very bad coming out of the NASDAQ crash. We go into a recession here, 2001 or so. 2002, we begin to recover, and the dollar is very strong at that point. But starting in 2002, we begin economic recovery. And what happens to the dollar? 2002 through beginning at early 2008, the dollar overall gets much weaker. Generally, those are pretty good years for the economy from 2002 through 2008. Those are good years, economically speaking. You've got economic growth above, 3% certainly, which we haven't had since then until now. And then what happens? 2008, everything turns bad, everything turns ugly. What happens to the dollar? The dollar goes way up. The dollar gets ridiculously strong. Why? Because everybody gets scared. When people are scared, they run to the dollar. Risk off, they say, right? So basically, you had 6 years of risk on and dollar weakness. And that's during that time you had rising prices, you had rising interest rates, but it's considered what we consider normal, right? Normal interest rates. And since then, it's been completely abnormally low interest rates, right? Abnormally low economic growth since 2008, right? And now we're finally seeing economic growth above 3%, and interest rates are rising. And what's happening to the dollar? The dollar is beginning to do this again, right? Looks familiar? It looks a lot like 2002, doesn't it? It's just the beginning all over again, 2002 all over again. The economy's starting to recover, and prices are going to begin to rise again, beginning to reinflate. And what's happening to the dollar? The dollar is beginning to go down. So what else? What's going up? If the dollar goes down, what goes up? Everything else, right? Oil, gold, real estate, stocks. Everything that you value in dollars rises. Does that make sense? Everything that you value in dollars rises. I think you're going to see real estate really take off here in the U.S. for my U.S. people, because of this. You're saying, well, Ed, if interest rates are going up, doesn't that go against common sense? I mean, interest rates are going up. Shouldn't real estate go down? Let me ask you this. Interest rates have been low for 10 years. And interest rates, in real estate probably should have done a lot more based on where interest rates were for the past 10 years. So, in other words, it's not always intuitive. Right? If people have extra money in their pockets, that's more likely to get them to buy a house than low interest rates. You could cut interest rates to zero, and we did. And a lot of people still didn't buy houses. Why? They didn't have any money. All right? You still have to have money in your pocket to buy a house. If you don't have any money in your pocket, you're not going to buy a house. But if you cut taxes, I think you're going to put money in people's pockets. Then they're going to buy a house. Even if interest rates come up a little bit, they're still going to be relatively low. And if you've got money in your pocket, then I could say, well, maybe now we're going to see, people stepping into real estate. Okay, so assets like real estate are going to move up, but not just real estate. What about gold? If the dollar falls, gold tends to rise. Now, it's funny. This weird little chart looks familiar to me. A double bottom that fails and then turns into a big rally. Where have I seen that before? I know it looks familiar because I had a losing trade on something that looks very similar to this recently. And I don't win them all. Nobody wins them all. Where did I have a losing trade on a very similar looking chart? Oh yeah, here it is. Double bottom fails, hits my stop, and then takes off. Yeah, it's a little irritating. That's on Aussie USD. Aussie, right, looks an awful lot like the price of gold right now. So Aussie, we said, was being driven by copper. That's not 100% true. There's no one factor that drives currencies. Aussie's being driven by copper. It's also being driven by gold. It's also being driven by dollar weakness, which could be the root of all of that, right? That strength in gold is partly driven by dollar weakness. Look at it this way. If the dollar is falling, right? Here's the dollar. If the dollar is falling, then you need more dollars to buy an ounce of gold. That's one way to look at it, right? And you need more dollars to buy an ounce of gold. So here's gold again. But it's not just gold. What else trades in dollars? It's not gold trades in dollars, but so does oil, right? So if the dollar falls, then you need more dollars to buy a barrel of oil. And what do you know? There's oil above $60 per barrel. That's U.S. crude, by the way, West Texas Intermediate, not Brent, for my friends over in the UK and elsewhere. This is U.S., which tends to be less than Brent. Okay, and but as you look at this, there's the big cup and handle, right? And we circled the breakout, and that's textbook. It breaks out and it pulls back to the breakout point, and boom. So it gives you a second chance, right? 55 was the key. 55 was the key number. 55 was this resistance right here. When it broke through that resistance, it broke through with authority, right? Because why? Why does it break through? Because once it breaks through, it's clear that you're getting out of this mess. That mess was a consolidation that went on for a couple of years. Once you get above 55, it gets out of there with authority. It pulls back to 55 and gives you one more chance to buy it. And now it's above 60 and see you later time, right? It's off to the races. A lot of people are asking also, does this have anything to do with what's happening in Iran right now? Don't really believe so. You can see this breakout actually occurs 2 months ago. The initial breakout in oil actually occurs 2 months ago. I think it has, let's put it this way. I would think that this breakout and rally in oil has more to do with the global economic recovery. If you think about it, there's more work, the factories are humming around the world, there's more stuff going on. You need more oil to make that happen, right? Economies are growing faster. You just need more oil. You're going to consume more oil when that happens. And so I think that's part of it. I think dollar weakness is part of it. Certainly what's happening in Iran could exacerbate this situation. And if you're not aware of it, there are huge protests that broke out in Iran over the past several days. Similar to 2009, it's a very oppressive regime, dictatorship, sort of a religious dictatorship that runs the country there. A lot of the people don't like it, and they're fighting back. But you don't have much to fight back with. One side has all the guns, and you've got rubber bands and stones. Basically, it's hard to win. So we'll see what happens. But 20 dead last I heard, but there's no way to know with any degree of accuracy. When the government controls the media, the government has all the weapons, the government controls the military, and who knows what we don't really know what's happening. But my understanding is that all of the majority of the protests happen far away from where most of the oil is located. You're not going to see a direct impact. Although certainly there are always other consequences that cannot be foreseen. So we'll see what happens. We'll see what happens. Very fascinating situation. Okay, so what's next? What's next? What about silver? Is silver along for this ride? Look at that. Now silver, you can see that sort of double bottom is here too in a different form. And it really breaks down hard. Silver is just trying to regain its losses. So not nearly as strong as gold or oil, which are breaking out to new highs. Silver is just trying to regain what it has lost. Okay. There's the silver continuous contract. Silver just not really getting, definitely a laggard here. I think what you'll notice with silver and gold is this. If gold really takes off and it sort of stretches away from silver, then you'll often see silver play catch up very quickly. It's an odd phenomenon that happens in this market, but as long as until gold really pulls away, I don't think you're going to see that happen. And gold is doing quite well, but it's really not much higher now than it was, say, in October. Right? It's really just at these levels. It's just barely above the levels that it was in September. Right. So the big picture, yeah, it's come up quite a bit since its December lows, but before that it came down quite a bit. So big picture, it's really not much higher than it was in September. But if you were to see gold really take off, if you were to see gold really rally, and because the big picture, it's still one big consolidation. What if it were to break 1400? See, that would be massive. If it were to break 1400, right now it's broken 1300. It's done that numerous times in the last few years, but it's never broken 1400. Not since 2013, right? So that's almost 5 years ago. So if you can get this above 1400 and it keeps going, now you're talking big rally. Now you're talking huge breakout. And now maybe silver begins to play catch up. Okay, that seems to be the nature of it. Nature of the beast. Okay, all right. So there's your commodities roundup, right? So gosh, we're sort of just going around the horn here. So back to USDCAD, where does this thing stop falling, technically speaking? I mean, could we go all the way back down to here? 122. It's possible. You look at this big bounce out of here. There was some support back here. Even this number, this 125, this was a huge bounce out of 125 from spring of 2016. Then we got another bounce just under 125 in summer of this past year. We break 125, we come back. It seems to form a topping pattern here on the weekly. Let's go daily here. See if we can break that down a little further. You see that's weird sort of topping pattern to add. I mean, what is it? It's like I don't know what to call it, honestly. Whatever it was, it had huge support at 126.75. Right? It's like a series of top, like a quadruple top. 1, 2, 3, 4. See ya. And if it comes back to 126.75, it's a massive short. Because right now, somebody must have bought it there, is thinking, oh, it keeps bouncing. It bounced from 126.75 here, and here, and here, and not here. So if somebody bought it here, right, which was only a couple of days ago, it's only 1, 2, 3 days ago, thinking it's going to bounce again at 126.75 because that's support. And they're thinking, okay, it's a buy. If they bought it here, now they're in pain. And they're saying, now they've become very religious. They're saying, please, God, I just want to break even. And this is their break even point, 126.75. So if the price gets back to 126.75, you've already got pent up selling pressure waiting to sell at 126.75. They're already there. They're already waiting to sell at 126.75. They're already waiting. Okay, they're already waiting to sell. So I would suggest we do the same. My plan would be to sell at 126.75. Now, for now, major support seems to be 125. Now, that's an old line that we drew in there, and you could probably move that line down to here. Look at all the bouncing, and this is 124.35. Look at all the support here and here. Now it's going to break, but look what happens. I'm going to zoom in on this area. Lots of support at 124.35. Ignore that 2. That's 2/10 of a pip. It's 124.35 seems to be the key right now. Look at all the support. And again here. And then it's going to break. And then the price gets back above 124.35 and it becomes support again. How does it do that? It's not supposed to do that. Traditional technical analysis tells you that once this support is broken, it should become resistance, not support again. And yet, there it is. It became support again right there. Okay, your eyes are not lying to you. I've seen this happen too many times. So my game plan would be sell short at 126.75 on Canadian dollar. I would cover certainly before it gets to 124.35. But that's 230 pips. It's a lot of room to work with. But that's just as a general outline of a game plan. We're going to be selling short at 126.75, assuming that this thing ever comes back there, right? Because right now it's dropping like a brick. It's acting like it never wants to come back. But you and I know, right? Eventually, odds are, right? Every dog has its day. And even though the dollar's in a downtrend right now, even in downtrends, you have green candles. The dollar is probably going to have a green candle one of these days before too long. All right. So we get a few green candles here on dollar CAD. Get it enough to get it up to 126.75. I'll be looking to sell short. Now that we've broken this completely, I've got about a 230 pip range. I've got to get my stop above 127. I haven't quite decided where to put it yet, but I know my stop's going to be above 127. Let's just go with that for now. My stop's definitely above 127. I have a red line above 127. I haven't quite decided exactly where to put it yet, but it's going to be above. Stop will be above 127. Will there be unfilled orders? Says Richard, at 126.75. Well, I'm assuming, Richard, that there are people who bought this, went long at 126.75, just based on the fact that it keeps bouncing there. So it was support. They were buying at support. If they bought at support, they're suffering right now. They're in pain. Pain's a strong motivator. They just want to break even. So their break-even point is 126.75. If it just gets back there, then that's their break-even point. They can get out at break-even. So we know this, right? If we assume that they can break even there, then we can assume there's going to be selling pressure at 126.75. That should make it very hard for the price to get above 126.75. So that's why I'm going to sell it at 126.75. So I don't know if I would call it unfilled orders. Let's put it this way. It's those who bought there are now motivated, is the way I would put it. They are now motivated to sell because that's their, sorry about that. They are now motivated to sell at that price because that is their break-even point. Right? It's a pleasure principle, right? They're in pain right now because they bought it. And surely, hey, listen, surely they should have used a stop and been taken out of the trade. And what people always say to me is, Ed, these are professional traders. They're institutional traders. They've used a stop. They've gotten out of the trade. There's no way they're still in the trade. And I will say to them, I will counter with this. That's what they should have done. You're right. They should have done that. And yet, history keeps repeating itself with people like Nick Leeson and Jerome Caraval and countless other people who always should have known better. Institutional traders who should have known better. The London whale, right? Institutional traders who should have known better and got themselves into trouble. And I'll tell you what, countless other ones that we've never heard of because they wriggled their way out of it. And we never found out their names. Yeah, they know better, and yet it always seems to happen, right? It always seems to happen. So institutional traders, individual traders, we all fall victim to the same problems, the same issues, right? I really recommend that pick up a copy of Behavioral Finance. Terrific book. Gosh, the author's name escapes me. He's British, though. He's got a U in behavioral, right? And pick up a copy of that sometime. Because they go into detail on all of these issues. I'm trying to Google this really quick on my iPad. James Montier. For anybody who's interested. Yeah, Behavioral Finance by James Montier, M-O-N-T-I-E-R. I highly recommend this book. This is my go-to on airplanes and such. He's hilarious. He's hilarious, by the way. It's not dry at all. It's actually quite humorous, but he delves pretty deeply into all of these issues that we all face and many of us fall victim to. I've been on a number of courses where candidates do not use stops despite being told to by tutors, says Richard. Yeah, the thing is, and people always rationalize. They say, well, I'll do it this way now, and then later on I'll do it the right way. But I just want to do it this way for now. It's amazing how people rationalize, But the truth is that however they're doing it now is how they're going to do it later. However they practice is how they're going to play, right? So it's just like in sports, right? When we practice, you practice like you practice the same way that you play. That's why we practice, right? So you don't practice one way and then play a different way. The way that you practice is the way that you end up playing. And so if you practice without stops, then when you're going to live trading, you're not going to suddenly start using stops. So a very good point there by Richard. And but that's a very common issue. I was in a room not long ago, Richard, and I will tell you this, and then we'll put a bow on it for today, where a person who's 25. Now I've been trading for 23 years, and I'm not trying to brag, but I'm somewhat known, for this. And here this person has been trading I've been trading for pretty much since this person's been in diapers. And this person's my student and has lost, at his age, at his young, tender age, has lost an incredible amount of money. And he's challenging me on doing it my way. He wants to do it his way. And I'm basically telling him in front of the class, look, you can do it your way if you want to, because we need people like you. We need people. The rest of us need people who are going to, take the other side of our trades. So if you really, and I'm trying not to be unkind, but I can't let him poison the room at the same time. So I'm trying to explain to him, listen, if you want to do it the wrong way, it's up to you. But I just want you to know, I'd prefer that you do it the right way. But at the same time, we'd like you to know that we need people out there doing this the wrong way. We need somebody out there to do it the wrong way. I don't want you to do it the wrong way. You're my student. I want you to do it the right way. But if you insist on doing it the wrong way, I just want you to know, for as long as you still have money in your account, we'll be happy to take the other side of your trades. And I'm not trying to be mean or anything, but I'm just being honest. And it's just the truth. But you cannot reach some people. You cannot reach some people. And if the young man he's sitting in the room and he's already lost $50,000 or whatever trading. But if he doesn't want to listen to what I have to say, well, why are you there? Doesn't really make sense, does it? Okay. Anyway, that is all I've got to say about that. So everybody have a wonderful day. And I will see you again very, very soon. So thanks for listening. Ed Ponsi here on behalf of FX Street. Have a wonderful day. And I'll speak to you again later this week. Everybody take care. Bye now.